Welcome back. We will be looking at the final portion of transfer pricing in this video. We have already understood that cost-based transfer pricing is the most common form, where your minimum could be the marginal cost and the maximum could be the external market price. So between this range, you can actually set up your transfer price based on negotiation and based on how much surplus capacity you have, that you can move freely to the other division, or if not. So we've looked at it from different scenario perspectives. Now, what we have to understand is that there are a couple of other alternative approaches to transfer pricing, and those two are two-part tariff and dual pricing. So these are again logically very easy for you to gauge or for you to get a handle on. Two-part tariff is very simple. The transfer price is this. Let's say you're the selling division, you manufacture the component. Two-part tariff means you will set up the transfer price at the marginal cost of the unit, that is the variable production cost of the unit. You can add any variable directly attributable fixed costs, directly attributable overheads also, if that is the case. So the marginal cost of the unit on a reasonable basis plus a component for the fixed cost. So two-part tariff is charging your marginal cost per unit and a lump sum, a separate lump sum to cover your fixed cost. This is two-part tariff. As long as your costs are covered, you would be happy. So this is definitely one of the most logical approaches to set up a transfer price at. The second is dual pricing. So in dual pricing, what happens is that both the divisions, the buying division and the selling division, will record the transfer prices at the most beneficial rate for them. So for the selling division, let's say you're the seller. For the selling division, what is the most beneficial transfer price? That would be the price at which you can maximize your profits, right? You can show a good profit, a higher profit, the highest profit. And that would be if the transfer price is set at the external market price. So what you do is, in your revenue line, you're the selling division, in your revenue line, you will record the transfer price as the external market price. Now, let's say I am the buying division. For me, what is the most beneficial? Because I'm the buyer, it's a cost for me. So what is the beneficial transfer price? That is to minimize the cost. If I can minimize the cost, then I can overall show a very positive impact on profit and show better results in my divisional P&L. So the minimum cost is the marginal cost of the unit. So I record that transfer at the transfer price of, I record it as if I bought the component from you at the marginal cost. But will this reconcile? When you add the two divisional profits, will it reconcile? No, because you and me, we both have recorded the prices at two different bases. You have recorded the external market price. I have recorded the marginal cost, which means that the contribution, the difference between those two, will be shown or will be displayed or will be expressed when you try to consolidate or when you try to combine the two divisional performances, maybe to look at the total company performance. And that difference is made as an adjustment by the head office. This approach is good for everyone, right? Because end of the day, transfer price doesn't have a cash-based impact on the company. It's just something that will affect the divisional manager's P&L and performance measurement and performance ratios. So this approach, what it does is it keeps you happy, because for you the profit is maximized. It keeps me happy because for me also profit is maximized, and the adjustment is made by the head office centrally. The buying and selling division recognize two different transfer prices. However, the problem with this is that at a period end, adjustment to the accounts is required. So this is management accounting. This is not financial accounting. Therefore, in management accounting scopes, there is more freedom for you to make these kinds of adjustments. So these are the two alternative approaches we have. So three overall. One is cost-based. The second is two-part tariff. The third is dual pricing. So have a thorough understanding, and I want to give you a slight disclaimer. And it's actually a positive one. See, the examiner is saying here, take the time to review and attempt the scenario-based question below. So in your Kaplan, you can try out Test Your Understanding 9, but you will not see, it contains a more challenging transfer pricing calculation and also requires an explanation of transfer pricing. So the APM exam is more relevant in terms of the explanation to transfer pricing. Now, thereafter, this is the important part. The examining team will expect you to be able to demonstrate and evaluate the use of alternative bases for transfer pricing, but will not be interested in testing very detailed or complicated calculations. Right? So, detailed calculations, complicated ones in transfer pricing, not APM. And some of it is AFM, some of it is F5, some of it is F9, but not AFM, right? So what you have to understand here is in your area, for you, what is relevant is you should understand the different transfer pricing approaches available. You should be able to look at a situation and determine a transfer pricing situation and determine if what they are doing, what that company is doing, is good, is right, is fair. We learned that a good transfer price has so many benefits in the first segment of this chapter. So those benefits are how you look at, you see whether those benefits are actually materializing. The third is you should be able to recommend a transfer pricing approach if it is a situation that demands a recommendation with justification. You should have clear logics, clear justifications to say, this is why I believe that dual pricing, or this is why I believe two-part tariff, or this is why I believe marginal cost plus 10% is the best transfer price to be used. So the examiner in the exam will paint a certain picture in a company. We have several examples of those which you will be looking at from past papers, several examples that you can actually refer to. You can look at the context, you can read the question, gauge the situation, and decide what the best way is to record the transfer price. That brings me to the final segment, which is international transfer pricing. And what happens with international transfer pricing is that it's a matter that occurs when the divisions are in two different jurisdictions, two different countries. And so this happens when there are multinational corporations involved with different divisions in different regions and different countries. Now, obviously, when you're in different countries, so let's say I'm in America and you're in the UK. So if I'm at the buying division and you're the selling division, then ultimately, sure, on paper, all good, right? All on paper, you can think that sure, I record the transfer price, but there's actually goods transferred across jurisdictions, right? It's not like in the same building you're transferring goods. So this means the tax system, the government, import, export, revenue transfer, all of these are involved, right? Because even treasury would be transferring cash from here to there. So cross-border transactions are at play here. And that is something that governments will not ignore, regardless of whether you are the same, whether you are two divisions of the same company. That doesn't matter. That country, that government will care about themselves, and this country, this government will care about themselves. In such a situation, what do we do? Now, there is an opportunity here for multinational companies. Let's keep aside the government. There's an opportunity here. The same thing that we did with, we understood with transfer pricing, with dual pricing, is that you can record because you have to pay tax, right? Let's say you're in the UK. So you have to pay tax to the UK. So what you can do is, let's say you're the selling division. If you maximize your revenue, if you show the higher transfer price, what will happen is your revenue will be maximized, and therefore your profit will be maximized, and therefore you'll have to pay a higher profit. So what you can do is you can, on paper, on your P&L, say that I transfer the good at the minimum price, at the lowest price, and thereby reduce your book profit, and thereby reduce the amount of tax you pay. I'm the buying division. What I can do is, on paper, I can say I spent too much money. I spent a lot of money. I can show a higher cost. A higher cost will reduce my profits in the books, and then therefore I will also pay lower tax. So what we are doing is we are using dual pricing as a technique to and recording two different transfer prices. The head office can make the adjustment because end of the day it's the same company. Maybe a bit of a currency adjustment or something will have to be additionally made, but otherwise we are using the dual pricing technique to minimize the tax commitment, the tax liability. Overall tax liability for the company can be reduced, and governments understand this. So when the buying and selling division may be based in different countries, we may try to increase profits for the selling division and the vice versa for the buying division by adjusting the transfer price to take advantage of the different tax rates. That's another thing. Now you can take a look at the tax rates also, because some governments, sometimes you pay a higher tax, sometimes you pay lower tax. Maybe in your country it's 30%, maybe in my country it's 40%, maybe I fall into a higher tax bracket. So we can also look at the tax percentage, and not only use the dual pricing technique, but to use the dual pricing technique by looking at the tax percentage to further ensure that we are minimizing the tax liability to the best possible ability. However, because governments understand this, they very closely monitor this, and they will generally not allow um, netting off or minimizing tax liabilities using transfer pricing. So the government will specifically say they will have a clear mandate, will have clear controls, and they will specifically track what goods are being transferred, and they will say this is how you have to deal with this. This is how you have to record the transfer price. Whether you do it or not, whether that is the price you transfer, doesn't matter. Our rule is this, and that is how you show the profits, and you pay tax on this. That is one. The other is the remittance control aspect, where a country's government may impose restrictions on the transfer of profits from domestic subsidiaries to foreign multinationals. So in any case, if it's a multinational corporation, whether it's two divisions transferring to one another, the money, right, the goods, sure, maybe you can facilitate it, but the remittance of money, and even import export of certain components, goods, material, etc., that is also involved in transfer pricing, because you're talking about cross border transactions, and that is also something that the government may control, because there could be other factors, macro factors, that the government is trying to manage, like the currency rates, forex rates, inflation, interest rates, those kind of things. So if you're a huge multinational company with major level transactions, big amounts moving from here and there, and you might need to get your hands on a large amount, billions of dollars, from a country that is poor, that has poor economy, then the government may restrict the transference of remittances um, from that country, at least for the time being. You might have to go through a lot of effort in order to facilitate this kind of thing. So this is another challenge that is involved with transfer pricing, and that is what the two scenarios that I explained to you about how dual pricing with tax rate is being used, where you and me, we both record different transfer prices to minimize the global tax liability. That is looked at as an example. So there we go. So we've looked at the two main challenges in the global environment as far as transfer pricing is concerned, which brings us to a completion, an end of the discussion on divisional performance appraisal and transfer pricing. On that note, I will see you soon. Thank you and good luck.